It's December 2025. Inflation has cooled, but prices never came back down. Real wages for most workers are lower than they were in 2019. The stock market is at all-time highs one week and down 10% the next. Commercial real estate vacancies in major cities look like ghost towns. Central banks are paralyzed, cut rates and risk a currency crisis, hold rates and watch debt defaults cascade. And beneath it all, a quiet, gnawing question almost no one wants to say out loud. Are we living through the early chapters of something that will one day be called the Second Great Depression? Let's be clear. Today is not 1931 yet, but the parallels are becoming impossible to ignore. First, the debt supercycle. In 1929, total debt in the U.S. economy was roughly 300% of GDP. By 2025, it is over 370% when you include federal, household, corporate, and financial sector debt. Private credit, those shadowy, unregulated loans to already over-leveraged companies, has exploded the way margin debt exploded in the Roaring '20s. Second, the inequality chasm. In 1929, the top 1% captured nearly 24% of all income, the highest level since they started keeping records. Today, after the post-pandemic wealth transfer, the top 1% takes home more than 22% and owns nearly 35% of all wealth. The bottom 50% owns less than 3%. When the majority of consumers have no savings and live paycheck to paycheck, one shock is all it takes to freeze spending overnight. Third, the everything bubble. In the late 1920s, people borrowed on margin to buy radio and automobile stocks at 100 times earnings. In the 2022s, we borrowed at near zero rates to buy tech stocks at 100 times sales, NFTs, meme coins, and 7-year auto loans on $90,000 pickup trucks. When the music stops, the unwind is symmetrical and merciless. Fourth, the banking fragilities. In 933, over 9,000 banks failed because they were stuffed with bad real estate and stock loans. In 2023, we already saw Silicon Valley Bank, Signature, and First Republic collapse under the fastest rate hike cycle in history. Hundreds of smaller banks are still sitting on hundreds of billions in unrealized losses on held-to-maturity bonds and commercial mortgages. A second wave is not a question of if, but when. Fifth, the global dominoes. The Great Depression went global because Britain abandoned the gold standard, countries devalued, and trade collapsed 65%. Today we have China's property sector, a $60 trillion black hole local government debt that can never be repaid, and European banks more exposed to U.S. commercial real estate than most people realize. One major default, and the contagion will travel at the speed of high-frequency trading. And finally, the political paralysis. In 1930, Herbert Hoover believed in voluntary cooperation and balanced budgets while the economy burned. In 2025, political systems around the world are so polarized that even obvious emergency measures, debt restructuring, direct household relief, or coordinated central bank action are dismissed as socialism or money printing before they're even debated. Music swells slightly. None of this is to say collapse is inevitable. The 1,930 seconds had no social safety net, no deposit insurance, no IMF, no ability to cut rates from 0% to negative. We have more tools. But tools are useless when policymakers are in denial about the scale of the problem. So what should you be watching? Commercial real estate maturities in 2026-2027 trillions come due that can't be refinanced. The inverted yield curve that has been screaming recession for over 3 years. The rapid decline in global shipping rates and factory orders, echoes of 2007 and 1000, 929. The moment a major sovereign or quasi-sovereign, think China local government financing vehicles, misses a dollar bond payment, history doesn't repeat, but it rhymes. And right now the rhyme is getting louder. The difference between 1929 and today is simple. Back then, almost no one saw it coming. Today, almost everyone feels something is wrong, but very few are willing to call it what it might become. Prepare accordingly.